$657 billion. That is how much money China has pulled out of United States Treasury bonds since peaking at $1.316 trillion in November 2013. Not projected, not estimated. That is the confirmed reduction tracked through official U.S. Treasury Department data, and it represents a roughly 50% drawdown of what was once the second largest foreign position in American government debt on the planet. Even if you have never looked at a bond in your life, never thought about what happens in Beijing's financial system, and never paid attention to a single Treasury auction result, this story connects directly to what you pay on your mortgage, your car loan, and your credit card statement every single month. Because China did not just quietly sell some bonds and move on. It replaced that money with something else entirely: gold. 20 consecutive months of central bank gold purchases, the longest unbroken buying streak since at least 2015, with the pace accelerating through the first half of this year. In June alone, the People's Bank of China added nearly 15 tons to its reserves, the largest single-month purchase since 2023. That is not a country making a routine portfolio adjustment. That is a country actively rebuilding the foundation of what it holds in reserve and deliberately stepping away from the US dollar system while doing it. And there is a geopolitical catalyst behind this shift that most coverage barely mentions. In 2022, Western nations froze approximately $300 billion in Russian foreign reserves following the invasion of Ukraine. That decision sent a signal to every government on Earth holding large dollar-denominated positions subject to U.S. jurisdiction. Beijing clearly received that signal. By the end of this video, you will understand exactly how this mechanism works, why it is accelerating right now, and what it means for the borrowing costs you personally pay every time you swipe a credit card or sign a mortgage document. I'm Simon, and this channel breaks down the global economy without the jargon and without the noise. If you're serious about understanding how real money actually moves in this world, subscribe right now. Drop a comment with where you are watching from, and stay until the very end, because the final part of this breakdown covers the one signal professional bond traders are watching more closely than any headline coming out of Washington right now. Let's start with the numbers, because they tell a story that most financial coverage completely misses when it only focuses on the latest monthly data point. China's Treasury holdings did not collapse overnight. They eroded deliberately over more than a decade in what amounts to one of the largest, most sustained sovereign wealth reallocations in modern financial history. At its peak in November 2013, China held $1.316 trillion in U.S. Treasury securities. As of the most recent data available through mid-2026, that figure has fallen to approximately $659 billion. That is a reduction of over $657 billion across roughly 12.5 years. And the pace has not been even. China shed 173 tonplant and $2 billion in 2022 alone. Another 50 tonplant $8 billion in 2023, an additional $57.3 billion in 2024. And in the first quarter of 2026, the selling accelerated sharply once again. In March of this year, China sold approximately $41 billion in U.S. Treasuries in a single month, contributing to a broader foreign sell-off of $138.4 billion that same month. By the end of March, China's holdings had fallen to roughly $652 billion, the lowest level since September 2008. Think about that timeline for a second. The last time China held this little American debt, Lehman Brothers had just collapsed, and the entire global financial system was in freefall. Now, here is the part that separates what is actually happening from what most social media coverage would have you believe. China's drawdown is not a panicked dump. Analysts at major institutions, including HSBC and the Economist Intelligence Unit, have specifically pushed back on the idea that this represents a chaotic exit. HSBC's global chief economist has noted that the de-dollarization narrative has been overstating what has happened so far, and there is a layer of complexity beneath the headline numbers that matters enormously. Research from the Council on Foreign Relations has pointed out that some of China's apparent reduction in direct treasury holdings may have been offset by shifting dollar assets into less transparent vehicles, including state commercial banks, custodial accounts in Belgium, Luxembourg, and Canada, and other entities that do not appear cleanly in the standard Treasury international capital data. In other words, some of the headline decline in Chinese Treasury holdings may represent reorganization rather than outright elimination of dollar exposure. That nuance matters because it changes the risk calculation. But even with that caveat firmly in place, the direction of travel is unmistakable. A 5-year analysis from RSM shows China has conducted a 36.6% structural reduction in Treasury holdings with no meaningful reversals. That is a trend, not a blip. And the trend just acquired a new engine. In early February 2026, reports surfaced that the People's Bank of China had issued what is known in Chinese regulatory practice as window guidance, verbal instructions delivered to the executives of China's largest state-owned banks, directing them to limit new purchases of U.S. sovereign debt and begin an orderly reduction of existing positions that exceeded internal risk thresholds. Window guidance is a traditional Chinese regulatory tool. It avoids formal written policy. It leaves no public paper trail, and it allows Beijing to distance the move from official diplomatic channels while effectively steering billions of dollars out of the American financial system. Markets reacted almost immediately. The 10-year U.S. Treasury yield climbed toward 4.25% within days of the reports. The Bloomberg Dollar Spot Index slipped, and the 30-year Treasury yield hit a multi-month high. That reaction was not panic, it was repricing. The bond market was doing what bond markets always do when a structurally important buyer signals a reduction in appetite. It adjusted the cost of borrowing to reflect the new reality of who is and who is not showing up to buy American debt. This is the mechanism that connects Beijing to your kitchen table, and it is worth understanding step by step because it explains something millions of Americans have been confused about for the past 2 years. The U.S. government runs a deficit. That is a simple fact. As of mid-2026, total gross national debt sits at approximately $39.5 trillion, increasing at a rate of roughly $7.7 billion per day, according to the Joint Economic Committee. To fund that deficit, the Treasury has to constantly issue new bonds, hundreds of billions of dollars worth every few weeks, auctioned off to whoever is willing to buy them. For decades, there has been a deep, reliable pool of foreign buyers for that debt, with China historically sitting near the very top of the list. When a buyer that large steps back, even gradually, the Treasury does not stop issuing debt. The deficit does not disappear. The government still has to find someone to purchase those bonds, and if demand softens while supply stays the same or grows, the price of attracting buyers goes up. In the bond market, that means yields rise, and here is where it hits you personally. The 10-year Treasury yield is the benchmark that mortgage rates in America are priced against. It influences auto loan rates, credit card APRs, corporate borrowing costs, and even what state and local governments pay to fund infrastructure through municipal bonds. When 10-year yields climb because major foreign buyers are stepping back, mortgage rates tend to follow upward even if the Federal Reserve has not changed its own policy rate at all. That disconnect is exactly what has frustrated millions of Americans who expected borrowing costs to come down and instead watched them stay stubbornly elevated. The Fed controls the short-term policy rate. But the longer-term Treasury yields that actually determine your mortgage rate respond to a completely different set of pressures, and foreign demand is one of the most important among them. Now let's talk about what China is doing with the money instead, because this is where the story shifts from a bond market rotation into something with much deeper implications for the US dollar itself. The People's Bank of China has been on a gold buying spree that is unlike anything in its recent history. As of the end of June 2026, the PBOC had purchased gold for 20 consecutive months, extending the longest unbroken accumulation streak since at least 2015. Total gold holdings reached approximately 2,346 tons, or about 75.44 million troy ounces. The pace has been accelerating. In March, the PBOC added 160,000 ounces. In April, 260,000. In May, 320,000. In June, 480,000, the largest single-month purchase since October 2023. That is not a steady drip. That is a ramp, and it is happening even as gold prices have been volatile, including a 16% decline in the second quarter of this year. Central banks do not trade for short-term profit. They allocate for long-term strategic positioning. The fact that the PBOC accelerated its buying during a price correction rather than pausing tells you something important about how Beijing views this move. It is not opportunistic. It is structural. Gold currently represents less than 10% of China's total foreign exchange reserves. The global average among central banks sits around 27%. Closing that gap, even partially, would require hundreds of additional tons of purchases over the coming years. The World Gold Council's 2026 survey found that 89% of central banks globally expect official gold reserves to increase over the next 12 months, and a record 45% plan to increase their own holdings. China is not alone in this shift. It is simply the largest and most consequential participant. Quick reminder before going any further. If this kind of real financial breakdown is useful to you, make sure you are subscribed and drop a comment with your biggest takeaway so far, because the next section is where this story starts connecting directly to the dollar in your wallet and the interest rate on your next loan application. Here is why the gold accumulation matters for the dollar specifically. Every dollar China moves out of U.S. treasuries and into gold is a dollar of demand removed from the U.S. financial system. When a country holding trillions in foreign exchange reserves actively diversifies away from dollar-denominated assets, it weakens one of the structural pillars that has supported the dollar's value for decades. China is not the only country doing this. In March 2026 alone, alongside China's $41 billion in treasury sales, Japan sold $47.7 billion. Luxembourg sold $13.7 billion. Taiwan sold $12.7 billion. Saudi Arabia sold $10.8 billion. India sold $7.6 billion. Canada and the United Arab Emirates trimmed their positions as well. The combined foreign sell-off that month was $138.4 billion. Not every major holder was selling. The United Kingdom added roughly $30 billion. The Cayman Islands added over $16 billion. Germany added a smaller amount. So this is not a uniform global exit from American debt. But the pattern forming underneath the headline numbers is significant. The buyers stepping back, China and Japan in particular, are historically the two largest and most consistent anchor holders of U.S. government debt. And the buyers stepping in, Cayman Islands entities in particular, are widely understood to represent hedge funds and leveraged investment vehicles rather than long-term sovereign holders. That is a meaningfully different kind of buyer. Hedge funds trade in and out based on short-term opportunity. Central banks and pension funds historically held for decades, swapping steady long-term holders for transient, opportunistic capital changes the stability of demand for U.S. debt over time, even if the headline totals look similar on paper. The dollar itself has already been reflecting these pressures. The U.S. dollar index, which measures the dollar against a basket of 6 major currencies, traded around 99 as of early August 2026, down roughly 10% from its January 2025 peak above 109. That decline has been driven by a combination of trade policy uncertainty, shifting Federal Reserve expectations, and the kind of structural capital rotation this entire analysis describes. A weaker dollar sounds abstract until you realize what it actually means for everyday life. A softer dollar makes imported goods more expensive for American consumers, which feeds directly into inflation at the grocery store, the gas pump, and the electronic shelf. It can also make American exports more competitive abroad, which benefits some manufacturers and exporters. So the effect is not uniformly negative, but for any household buying goods that come from overseas, a weakening dollar is a direct hit to purchasing power, layered on top of whatever borrowing cost pressures are already building through the Treasury yield mechanism. There is also a fiscal feedback loop here that deserves serious attention because it is the piece that professional bond traders watch most closely. As foreign demand for U.S. debt softens and yields rise, the government's own borrowing costs increase. The average interest rate on the total marketable national debt sat at roughly 3.41% as of mid-2026, more than double the 1.47% rate from 5 years earlier. Net interest payments are now consuming approximately 14% of all federal outlays, according to Congressional Budget Office forecasts. That means a growing share of every tax dollar collected goes towards simply servicing existing debt rather than funding programs, defense, infrastructure, or anything else. Higher yields mean higher interest payments. Higher interest payments mean larger deficits. Larger deficits mean the government has to issue even more debt, and more debt issuance requires finding even more buyers in a market where some of the most reliable traditional buyers are stepping away. That loop does not require a crisis to become a problem. It just requires time and math. Now, here is the honest, balanced part of this analysis, because responsible coverage of this story requires it. China's treasury reduction, as large as it is in dollar terms, still represents a gradual, multi-year reallocation, not an abrupt, weaponized dump. The $659 billion China still holds is an enormous position. Total foreign holdings of U.S. treasuries actually climbed to a record $9.49 trillion in February 2026, according to TIC data, even as China and other individual holders were reducing. That means other buyers have been absorbing the slack, at least so far. Additionally, research from the Council on Foreign Relations suggests China may not have truly de-dollarized as much as the headline numbers imply. Some dollar exposure appears to have shifted from official PBOC reserves into less transparent state-linked entities, including commercial banks and investment funds. If that analysis is accurate, the true reduction in China's total dollar footprint may be smaller than the Treasury data alone suggests. These are important caveats. They do not erase the trend, but they do put it in proper context. This is not a story of imminent collapse. It is a story of structural repositioning by the world's second-largest economy, playing out over years with real but manageable consequences for American borrowing costs and dollar strength. The question is not whether this matters. It clearly does. The question is whether it remains orderly or whether something causes it to accelerate beyond what markets can smoothly absorb. So, what should you actually be watching if you want to track this like a professional rather than react to it like a headline reader? 3 signals matter more than anything else right now. First, watch U.S. Treasury auction demand. Every few weeks, the Treasury auctions off new debt and the results are public. When foreign demand at those auctions weakens, when what is called indirect bidder participation drops, that is a real-time signal that buyers like China are continuing to step back. Weak auctions tend to translate into higher yields within days, and those higher yields tend to show up in mortgage rate quotes within weeks. The bid-to-cover ratio for 10-year notes sat at 2.40 as of mid-2026. A sustained move below 2.0 would be the kind of signal that genuinely concerns the people running the desks. Second, watch PBOC gold reserve disclosures. China's State Administration of Foreign Exchange publishes monthly reserve data in the first week of each month. If the gold buying streak extends and the monthly volumes keep increasing, that is confirmation the structural shift away from dollar assets is accelerating, not stabilizing. June's 15-ton purchase was the largest since 2023. If July or August exceeds that, the trajectory speaks for itself. Third, watch the foreign share of total U.S. debt outstanding. Morgan Stanley analysis of Federal Reserve flow of funds data recently put foreign ownership of U.S. Treasuries at 32.4%, the lowest share since 1997. That metric captures the broader trend better than any single country's monthly data point. If that share keeps declining while the total debt pile keeps growing, the pressure on yields compounds in ways that are difficult to reverse without either dramatic fiscal consolidation or a willing buyer of last resort stepping in. Here is the bigger picture to hold on to. For over 2 decades, the arrangement between China and the United States was one of the quietest pillars of global finance. China ran enormous trade surpluses with America, accumulated dollars, and recycled those dollars back into U.S. Treasury bonds, effectively lending America's own money back to it at low interest rates. That recycling loop helped the U.S. government fund persistent deficits without triggering the kind of yield spikes that would normally accompany borrowing at this scale. It kept mortgage rates lower than they might otherwise have been. It supported the dollar's status as the world's primary reserve currency, and it gave American consumers access to cheap imported goods funded by cheap government borrowing. That arrangement is not collapsing overnight, but it is eroding deliberately and structurally, driven by a country that has decided its long-term strategic interests are better served by gold in a vault than by IOUs from Washington. Whether that judgment turns out to be correct is a question only history can answer. But the financial consequences of that judgment are already showing up in Treasury auction results, in yield curves, and in the borrowing costs that millions of Americans encounter every time they apply for a loan. The money is moving, the direction is clear, and the people who understand the mechanism before it becomes front-page news will be far better positioned to make informed decisions about their own finances than those who find out after the fact. If this breakdown gave you a clearer picture of what is actually happening between Beijing and the American bond market, subscribe because this channel covers exactly this kind of story every single week, the real mechanics behind the biggest money moves in the world explained in plain English. Drop a comment with what surprised you most about this story and share this with anyone who still thinks what happens in China's central bank has nothing to do with their own mortgage rate. Thanks for watching until the very end. This story is far from over, and we will be tracking every data release as it comes. See you in the next one.